welcome to NDTV Profit. You're watching KYC. I'm Hiral Datia, and with me is Puneet Javeri. The company today on KYC's radar is Ugro Capital. Lots to talk about this. Let's quickly understand what are the key questions we want to ask the management. We're talking about the recent fundraise, How are the funds going to be deployed? Because multiple fundraisers is what we've seen from a Ugro Capital. Secondly, when you talk about the scalability of the current business model, and here we're talking about, GRO Chain, GRO Plus, and GRO Extreme. And lastly, on my radar is going to be the acquisition strategy of the company, because two acquisitions that we're already talking about. From here on, is it going to be a business model which will be led through strategic acquisitions, or is it going to be organic growth?
Well, a couple of other questions in this particular point of time. One will be on net interest margins for the company. What will be the strategy? What will be the stability rate that investors can expect at this particular point of time? And of course, the return of assets. Will it likely improve? Will it likely sustain at these levels? That will be question number 4. And the final question on AUM growth. Now, it's a tall ask that the company has put in itself in FY27, and that will be led by its verticals in the emerging market, in the secured business, but it's a tall ask to say the least. What will be the company's strategy? Which product basket and customers are they targeting? Those will be the 5 key questions that we'll be asking the management of Ugro Capital today.
Okay, so let's quickly take the viewers through all the parameters that we're going to talk about in terms of where the company goes as well. Firstly, a company which is a NBFC, it is absolutely tech focused. So that's the interesting aspect that we're talking about on this front. Secondly, if you see in terms of the other aspects as well about the company, you're talking about it's mainly focused on MSMEs and small businesses. So clearly the asset quality risk becomes absolutely crucial, and the provisioning that the company has to make becomes absolutely crucial over here. And the recent RBI circular, whether any impact that comes in on their business, is what we need to see. If you talk about their products as well, GRO Score 3.0, that's the proprietary underwriting and credit scoring model product that they have. Secondly, they do multiple sourcing and lending channels. Second aspect. And thirdly, they are co-lending as well, and they have lending as a service, which is LAS. These are the key products that they're looking at, Puneet.
And definitely, in terms of recent updates as well, there have been a few to say the least. They've raised capital essentially at this particular point of time via convertible debentures as well as warrants. And the key update has come in yesterday that they've finally allotted that to its investors as well. We'll quiz the management on that. Launched 400 crores of a rights issue that's largely to fund the growth in the MSME portfolio of the company. And finally, in terms of MyShub Life, and he'll just speak about what could be the acquisition strategy of the company. How will this be deployed in terms of a new basket that the company will be looking at in terms of those key customers of MyShub Life as in terms of this aspect, and acquiring Profectus Capital as well has been the other one in an all-cash deal. Those are some of the key recent developments about the company, and this was of course a very big acquisitions of roughly about 1400 odd crores. So that's the key in terms of recent developments as well. Let me first start off with the income statement of the company. And
but before that, Puneet, let's understand the key parameters that we're going to discuss
sure. Let's go.
In terms of the company. Income statement, balance sheet, I know everyone knows it all, but operational matrix is what we will consider here as well, from the asset quality to moving on the shareholding, street credentials, valuations, and the street coverage. So these are the parameters that we will be discussing. But Puneet, over to you. Income statement, it's a very interesting one.
Well, definitely, it has seen growth in this particular point of time. The net interest income has seen almost a 20% growth on a 3-year basis. Profits as well are actually grown at a CAGR of almost 53%. But the reason we've given this a neutral rating, we are, looking at how the credit cost has also subsequently gone up at this particular point of time. While the net interest income have gone up 20%, the credit cost of the company has gone up almost 45% in terms of a 3-year CAGR in this particular point of time. So hence we've given this a neutral. We are being very stringent because the growth has been strong in terms of the asset under management, but definitely something that the company will want to improve going forward. So a neutral rating to start with, at least on the income statement, Hiral.
Okay, so that's with regards to where the income statement goes. Now let's look at the balance sheet. It's really interesting to see how the balance sheet has modeled out so far. To take you through, first up, if you see in terms of where the rapid growth in assets go, that is seeing a good scale. AUM, what is interesting is it's nearly doubled from FY23. We were at 6,800 odd crores. It's gone up to almost 12,000 odd crores. From here on, will this year see a 24,000 crores, and the year after probably a 50,000 odd crores is the key question that we need to see asked with the management. So that's with regards to where the AUM goes. If you talk about the loan assets as well, there is a rapid growth that has come in on the asset side. The leverage has also increased, but this is pretty much in line with the growth of the company. The loan book, that is the advances, are expanding very quickly for Ugro as well. And the advances, which is the loans and advances on the asset side, have really jumped fast. So, I was just looking at the numbers from 3,900 odd crores, it's actually gone up to 8,300 odd crores, which is actually showing that Ugro is pushing out more loans on asset growth. And this fits very well with that reported AUM number that you've been seeing on the screens. And in terms of their equity capital raises and reserves, just to add that point over here, the growth that they've seen in terms of equity, which is the net worth, seems to not just, come in from the profits, but also from the recent capital raises that they have done through issue of equity, convertible instruments, and retention, because there's been a large capital raise that has happened in FY24 as well. But overall, a thumbs up on this front.
And that's definitely, shown a strong growth in terms of assets under management, loan disbursements as well. So definitely that point taken. When you look at how this has effectively impacted the company's yields, impacted the company's return on assets, is something to watch now. Now, they have, maintained decent yields of roughly between 17 to 17.3%, and that's largely because they are looking at a slightly more risky consumer compared to what the traditional banks do. So you will have a much, much higher yield here, and that's maintained at a positive level despite the disparity in interest rates cuts as well as what RBI has done. But that, in terms of cost of funds, the company actually has not been able to reduce their cost of funds at this point of time, secure those, the funds which are between 8 to 9%, and here's where the differentiation will come in terms of valuation, and we'll be talking about that as well at the end. Because the return of assets, while it has grown from FY23 levels, it was at a very low level compared to its other peers in the same segment. So it has improved now in line with industry as well as peer average. But in terms of cost of funds, that'll be something to watch, and hence we've given this a neutral rating at this particular point of time.
Okay. Moving on, let's look at the asset quality as well, because if you talk about the gross NPAs and the net NPAs. The gross NPAs has crept up, if you see, from a 1.6% to a 2.3%. Similarly, in terms of the net NPAs as well, they've risen from a 1.1% to nearly a 1.6%. Now, this is not a major spike that you've seen in terms of the asset quality, but it is indicating some modest deterioration as well, and consistent with a growing loan book and the maturation of the portfolio that comes in as well. If you have to talk about their restructured portfolio, that is also declining, but it's a small portion because that has stayed at around 0.5% in FY24 and then down to almost 0.2% in FY25. So this is a good sign because Ugro is not really depending heavily on restructuring to manage its weak credits. So that is the reason why we've given it a thumbs up in terms of the asset quality.
And that's largely, a key one to watch as well, the net NPA, how that has moved. But let's look at the shareholding here now. And, while most companies, like HDFC don't have a promoter as well, but a lot of the NBFCs do have a very strong parentage. In terms of Ugro Capital, that stake is actually quite low at just 2.25% in terms of June 2025 for promoters. Foreign investors as well as the retail public largely dominate that shareholding, and hence, this is a clear thumbs down from our side in that aspect. Stability of promoter, while positive, will be something to watch in terms of any kind of events that negatively impact the company. Who will be backing its shareholders will be something to watch. So we've given this thumbs up because of the low promoter holding at this point.
Okay, so that's a thumbs down coming in terms of the shareholding. But let's look at the street credentials. Again, a thumbs down on this front because, the returns that the investors have got, are pretty okay. In the last 1 month, a 5.7% is what we've seen. YTD as well, it's a 17% downtick on the stock price. And over the last 5 years, it's just 57%. And that's the reason why we've given it a thumbs down in terms of where the street credentials go.
When you compare that to valuations as well, how does that shape up? you'll see a clear benefit in terms of lower valuations for Ugro Capital. And I spoke about how the cost of funds and return of assets are kind of looking at this aspect, because you see other players like Credit Access Grameen as well as Mass Financial are commanding a premium of roughly between 2 to 3 times price to book, while Ugro does offer that comfort. So if the company is able to improve some of the financial metrics, you will start seeing that in valuations. But this is a clear thumbs up based on how peer valuation is panning out, and definitely something that investors can look at, considering the risk as well as, in terms of downside that is largely protected because of it trading less than 1 time at price to book for the company.
Okay, and very lastly, the street, coverage, a neutral rating coming in there because you just have 6 analysts who are tracking the counter with a buy call. The reason we have not given it a thumbs down is because it's got almost a 37 to 38% upside from the current market price from the 6 buy calls that we have, and hence a neutral rating coming on this one. So now let's look at the final rating from NDTV Profit on Ugro Capital. You're talking about all the aspects from your income statement, balance sheet, operational matrix, asset quality. 2 are a thumbs up. Income statement and operational matrix is a neutral. Street coverage is a neutral, whereas your valuation is a thumbs up as compared to your peers. Shareholding and street credentials, we already told you why it's a thumbs down. 4.5 on 8, still a decent rating coming in with regards to where Ugro Capital goes. But, viewers, we'll quickly slip into a short break. Up next, after the break, we'll discuss all of these parameters with Shachindra Nath, founder and managing director of Ugro Capital. Please stay tuned. Welcome back to Know Your Company. We're talking to the management of Ugro Capital. Shachindra Nath, founder and managing director, joins in. Shachindra, welcome to the show and a pleasure to speak to you as always. The key factor that we're talking about right now is the fundraise. You've just come out with almost a 900 crore compulsory convertible debenture. If you could help us understand the entire fundraise structure, because you're talking about the recent CCDs, then you have warrants as well, and you have a rights issue. So what is that overall fundraise that you've done so far? What is the deployment going to look like? And secondly, you did have IIAS, which had actually flagged some bit of criticism as well when it comes to warrant holders who might not convert or benefit even if they do not end up assuming equity. If you have to club all of this together, your initial comments.
Yeah, before that, I just wanted to take up, I was just listening to the commentary of your KYC. I think so among your thumbs down, one of the things which you have thumbs down is promoter ownership. Now in financial services business, while it's very odd that for banks we are not allowed to have promoters, but for NBFC, all of you as analysts and media over rely on a promoter, right? You don't do that for the banks. Ugro technically does not have a promoter. It just so happened that I acquired a listed company in 2018 and entered into a shoe of a promoter, but I'm a professional running a professional setup. But what all of you don't, highlight that 55% of Ugro's capital ownership in hand of 4 very, very established global strategic private equity fund. Roughly around 15% of our ownership in the hand of Samina, which is a very large private equity fund out of Dubai. Around 12.5% is with the Denmark government. And then we have TPG Newquest and ADV Capital Partners. Then we have 2-3 large family offices. So Ugro gets support from its institutional shareholder base. We keep saying Ugro is an institutionally owned, professionally managed, and independently supervised company. So while I take the point that while you say it's a promoter ownership, it just so that SEBI regulation does not allow Ugro to declassify promoter, but otherwise Ugro doesn't have a promoter. I operate in a very professional capacity, and my ownership is the amount of the capital which I have put into the company. Second, also on your cost of fund, as some of you, over rely on promoter ownership, also so as the liability provider, rating agencies and liability, the cost of borrowing difference between us and some of the in NBFC space promoter owned entity is very, very significant. So for example, large NBFC owned by a significant Indian shareholder would have a cost of borrowing in the range of 8% versus we are at 0.5%. But I think so. Over a period of time, that would, with performance, that would keep going down.
Absolutely. And Shachindra, with performance, that will go down and the ratings will keep going up as well. But let's come to the point, because then we will, run short of time.
So I'll come to your capital question. First
Yes.
on ISS. I think so ISS made a judgment error. Obviously, whatever comment they get, no investor have taken any heed of that. That's why all of our shareholder approval resolutions got approved. So I don't want to, that I have discussed in length in your previous show. With respect to the total capital raise, Ugro from its inception till date have raised more than 3,000 crore of institutional capital. In the current round, we raised, around 380 crore from right issue. And then we did a preferential allotment of 900 odd crore, of which around 530 odd crore have hit our account yesterday. And we did a tier 2 raise of around 250 odd crore. So in total, we are standing at a 29% capital adequacy. There were twin purpose of raising this capital, obviously for augmenting our growth. Whenever this company reaches in the range of 18% capital adequacy, we raise more capital. But more so this time, we utilize this capital to do an acquisition. This acquisition was announced. We received an RBI approval within first 3 months itself. So we had acquired another NBFC called Profitability Capital, which has a 3,500 crore of AUM. We acquired it for 1,400 odd crore. So the entire equity capital is getting utilized to acquire a 3,500 crore NBFC, which is very similar to our segment of the market. So it is more consolidation. So we'll stand at around 15,500 odd crore. And we think that we'll be able to take out roughly around 130, 140 crore of cost. So incrementally increase our ROA by 0.7% and also give us two more asset classes. So they are very large in the school financing business, which we want to expand. And also it would improve our secured portfolio mix by a certain basis point. One of the other unique thing which I think the street doesn't like, that we are very heavy on the co-lending. Almost 42% of our assets are in form of co-lending or direct assignment. We think that's a very superior model, but with this acquisition, that also would come down to 35%.
Right. Mr. Nath, thanks so much for joining in, and very good afternoon to you. It's Puneet this side. Largely in terms of, you are increasing, as you mentioned, your secured business book. Your current business book will come down, which is the unsecured part. You are running that down a little bit because of the higher GNPA cost. But just wanted to understand, because you are expecting cost to increase there as well. So how will the reduction essentially in taking out some of the expenses from acquisitions as well as from the current book, but you are expecting some increases in this aspect of the business. Talk us through that as well, because you are expecting some pricing pressure because of the competitive landscape in the secured business book side as well. So how should investors look at both these aspects?
There are too many questions at one go, Puneet, but I'll answer each one of them. First, we have, so I think so we, our unsecured business, we normally cap at 30% of the total asset book. We have two kind of business, what we call business loan and what we have acquired last year called embedded financing. We are transitioning our business loan business to our embedded financing business. So it is the product mix which is changing. The reason that we target the GNPA in our unsecured business loan at roughly around 5%, credit cost of around 2.5%. So it is within our targeted range. But what we have realized that between BL and embedded financing, the return metrics on the embedded financing is far superior. So over a period of last 1 year or 10 months or so, we have built a book of around 1,300 odd crore on embedded financing. We are one of the largest player on merchant embedded lending through PhonePe, Fino, Airtel, BharatPay, and we are increasing that, and consequently we are reducing our BL business. So that our ROEs improve on that, and we think that is far more superior product than the open business loan lending. That's part one. Number two, in terms of the cost reduction, because the Profitability's business operate in the same four asset lines which we operate. So there is a replication of manpower cost, replication of physical infrastructure cost, and replication of technology cost. And once we combine these two businesses, we think that there is an operating leverage of around 130 to 140 crore would come from that. With respect to competition and secured asset, over a period of last 2 years, we have added around 200 plus location and entered into around 11 states to focus on what we call emerging market small ticket lab business. Today, offer gross disbursement of around monthly disbursement around 600 odd crore. 200 crore comes from this segment of the market. And as these branches would mature, this would become 400 odd crore. So our portfolio yield would increase. And this is a segment of the market wherein there is competition, but not enough competition.
So Shachindra, two questions because we are running short of time. One, the recent RBI circular, will that mean that Ugro will have to increase provisioning, because of which your credit cost could increase, and that could put pressure in terms of your earnings and on profitability? I'm talking about the ECL norms that have come in. Does that impact a Ugro, number one? And number two, is there a possibility of a Ugro doing a 50,000 crore AUM by FY27 at the rate that your AUM is growing already?
No, ma'am, there is no possibility. We add only 3,000 crore asset a year. So we cannot get to 50,000 crore by 2027 at any given point.
What year do you think you would be able to target that?
So we add, if you look at our track record, we add around 3,000 crore AUM every year, and that's our guidance. Actually, we are calibrating our growth little, lower so that we can improve the profitability. That's point one. Number two, the ECL guidelines is bank. NBFCs are already under ECL provisioning, so that doesn't change anything. In fact, under the current statement, the risk weight on MSME financing is being reduced. And once the final guideline comes, actually Ugro business model will become more efficient because 100% of our asset is MSME asset, which qualifies as priority sector. We focus on customers which are in trading turnover band of 25 lakh to 15 crore. So once the risk weight for NBFC on MSME financing is reduced, we'll become more capital efficient like housing finance businesses.
Comes absolute positive for a company like Ugro, and a 3,000 crore increase in terms of AUM is what the street should be watching out for. But thank you, Shachindra, so much for joining us on the show, and congratulations once again on the fundraise and the acquisitions that you've been doing. But completely out of time. With that, it's a wrap on this edition of KYC from Puneet, the team that put the show together, and myself. Lots more lined up on the other side. Please stay tuned to NDTV Profit.